Something unprecedented just happened. Bank of America, one of the world's largest financial institutions with over $2 trillion in assets under management, just released a metals forecast that doesn't adjust expectations. It shatters them. Michael Widmer, their head of metals research, just told institutional clients that silver could reach between $135 and $309 per ounce. Let me say that again, $309 per ounce. This isn't coming from a precious metals dealer trying to sell you coins. This isn't coming from a YouTube channel with silver in the title. This is Bank of America, the same institution that has historically been conservative on commodities, the same bank that spent years focused on traditional equities, the same analysts who generally avoid making aggressive forecasts. They just reversed course completely on silver. And when banks of this caliber make calls like this, they don't do it for attention. They do it because their internal data, their risk models, their supply chain analysis is telling them something has fundamentally changed. Right now, as of January 7th, 2026, silver is trading around $79 per ounce. That's already up approximately 150% from where it started 2025 at around $29. It's already surpassed the 1980 high of $49.80 that stood for over 40 years. It's trading near all-time nominal highs. And Bank of America is saying this rally is just beginning. That $79 could become $135 or $309. That represents a potential gain of 71% on the conservative end, or 291% on the upper projection, from current levels. In the next 15 minutes, I'm going to show you exactly why Bank of America made this forecast. I'm going to explain the mathematical framework they're using based on the gold to silver ratio that has predicted every major precious metals move in modern history. I'm going to break down the three converging forces, supply deficit, monetary instability, and institutional flows that make this projection not speculative but structural. And I'm going to show you why this matters more than any silver forecast you've heard before. Because when one of the world's most conservative banking institutions tells their wealthiest clients to pay attention to silver, the smart money listens. This isn't a trade recommendation. This is an analysis of what the institutional world is seeing. And what they're seeing is a market transformation that most retail investors haven't recognized yet. Let me show you exactly what Bank of America knows. Before we analyze the forecast, you need to understand the source. Bank of America Global Research isn't a speculative shop. They manage analysis for institutional clients, managing trillions in assets. Their commodity team advises pension funds, sovereign wealth funds, hedge funds, the people who allocate billions with a phone call. Michael Widmer has been their head of metals research for years. He's made notable calls on gold's move toward $4,000. He predicted central bank accumulation would accelerate. He's not a permabull who calls for rallies every quarter. He's an analyst paid to be accurate. And here's why this specific forecast matters. Widmer isn't making a speculative prediction. He's presenting a mathematical projection based on historical ratio reversions. He's stating that if the gold to silver ratio returns to levels seen in previous precious metals, bull markets, and if gold averages around $538 per ounce in 2026, as Bank of America forecasts, then silver mathematically trades between $135 and $309 per ounce. The gold to silver ratio is straightforward. It measures how many ounces of silver equal 1 ounce of gold. Currently, that ratio sits at approximately 59 to 1, meaning you need 59 ounces of silver to buy 1 ounce of gold. Historically, during precious metals bull markets, this ratio compresses significantly. In 2011, during the last major silver rally, the ratio reached 32 to 1. In 1980, during the Hunt brothers era, it hit 14 to 1. These aren't arbitrary numbers. They're historical data points that occur when silver dramatically outperforms gold during monetary stress. Widmer's calculation is mathematical. If gold averages $4,538 as Bank of America projects, and the ratio compresses to 32 to 1 like 2011, silver would trade at $142 per ounce. If the ratio compresses to 14 to 1 like 1980, silver would reach $324. His report rounds these projections to a range of $135 to $309. The methodology is ratio reversion, not speculation. It's applying historical patterns to current price levels. Here's the critical insight. At a 59 to 1 ratio, silver remains historically undervalued relative to gold. If we simply revert to the 2011 ratio of 32 to 1, silver is undervalued by approximately 45% from current levels. If we consider the 1980 extreme of 14 to 1, silver is undervalued by over 75%. Even after silver's 150% rally in 2025, it remains inexpensive compared to where ratios compress during precious metals bull markets. Bank of America isn't predicting this happens immediately. They're stating the structural conditions exist for this to unfold over the next 12 to 24 months. And those conditions aren't speculative sentiment, they're physical fundamentals. Let me show you what they're observing. The first structural force is supply deficit. Not a temporary shortage, but a multi-year deficit that's now in its 5th consecutive year. The silver market has been consuming more silver than miners produce since approximately 2020. This isn't disputed. It's documented by industry analysts, including the Silver Institute and Metal Focus. The deficit for 2025 is estimated at over 60 million ounces. The projection for 2026 shows continued deficit conditions. Why does this matter? Because unlike financial assets that can be created with keystrokes, physical silver requires mining. Silver mine production has been relatively flat to declining for years. Approximately 75% of silver production comes as a byproduct of mining other metals, copper, zinc, lead. This creates what economists call inelastic supply. The price of silver can double and production barely responds. Why? Because miners aren't primarily mining for silver. They're mining copper or zinc. Silver production is tied to demand for base metals, not silver prices. Meanwhile, demand continues accelerating. Industrial demand for silver reached record levels in 2025. Solar panels, electric vehicles, 5G infrastructure, data centers, all consume silver. The Silver Institute projects industrial demand will continue growing through 2030, driven primarily by green technology. Solar installations alone are expected to double over the next 4 years. Each panel requires 15 to 20 grams of silver. Once silver enters a solar panel, it's locked away for 25 years. It's effectively removed from available supply. This dynamic is draining above-ground inventories. COMEX registered silver, the metal available for delivery against futures contracts, has declined from over 150 million ounces 2 years ago to approximately 113 million ounces in late 2025. That's a 25% decline in available inventory. And it's draining at a rate of 1 to 2 million ounces per week during periods of elevated delivery requests. At certain drain rates, registered inventory could theoretically reach critically low levels in 2026. Bank of America observes this. They have access to vault data. They monitor London silver inventories declining. They see Shanghai trading at premiums to New York. When Shanghai trades silver at $84, while New York trades at $79, that $5 spread represents physical metal flowing east. And once metal leaves Western vaults for Chinese solar manufacturing or Indian jewelry, it doesn't return. It's consumed. This is structural force number 1. A supply deficit that cannot resolve quickly because mine production takes years to increase and industrial demand continues rising regardless of price. The second force is monetary instability. Bank of America's report uses careful language. They reference fiscal stimulus and policy uncertainty. But the underlying message is clear. Governments face difficult fiscal positions. The United States runs a $2 trillion annual deficit with $38 trillion in total debt. Interest payments are approaching $1.2 trillion annually. That's more than defense spending. Europe faces similar challenges. Japan's debt to GDP exceeds 250%. These aren't sustainable trajectories. When confidence in fiat currency management weakens, capital flows toward tangible assets. Gold has historically been the primary safe haven, but at $4,400 per ounce, gold has become expensive for many retail investors. Silver at $79 remains accessible. When investors recognize silver is undervalued relative to gold based on historical ratios, capital flows toward silver accelerate. This is the substitution effect. Investors who cannot allocate to gold allocate to silver instead. And because the silver market is approximately 10 times smaller than gold by total market value, the same capital inflow creates proportionally larger price impacts. Bank of America's Widmer specifically noted this dynamic. He stated silver appeals to investors willing to accept higher risk for additional upside potential. That institutional code for silver is the high beta play on precious metals. When gold rises 10%, silver historically rises 20 or 30%. When gold makes consecutive all-time highs, like it did throughout 2025, silver eventually catches up, and then overshoots. Currently, gold has outperformed silver over the past 2 years. The ratio at 59 to 1 reflects that outperformance. Bank of America's forecast suggests that the relationship is reversing, that the next phase of this precious metals bull market will be characterized by silver outperformance. And when silver moves, it doesn't move gradually, it accelerates. This leads to structural force number 3, institutional allocation. For years, silver was ignored by large institutional investors. Pension funds, endowments, sovereign wealth funds held gold, but not silver. The perception was that silver was too volatile, too small, too industrial. Not a serious monetary asset for institutional portfolios. That perception is shifting, and when institutional behavior changes, capital flows are enormous. Bank of America's report specifically mentions that high net worth investors currently allocate only approximately 0.5% of their portfolios to precious metals broadly. Meanwhile, optimal portfolio models suggest allocations of 20 to 30% would be appropriate, given current monetary conditions. That's a massive allocation gap. And as monetary stress continues, that gap begins closing. Not slowly, rapidly. Because once the narrative shifts from diversification to preservation, capital movement accelerates. Institutions don't purchase silver 1 ounce at a time. They allocate through ETFs like SLV, which holds over 500 million ounces. When a pension fund allocates $100 million to silver exposure, authorized participants must acquire physical metal to back those shares. They purchase from refiners, vaults, and dealers. If physical metal availability is constrained, premiums increase, or share creation slows, either outcome supports higher prices. Market observers noted that ETF inflows in 2025 were the highest since 2020. Silver mining equities rallied despite broader equity market volatility. These are early indicators of institutional positioning before broader recognition. Bank of America's forecast effectively tells their institutional clients the broader recognition phase is approaching. Position now before premiums expand and availability tightens. 3 converging forces: structural supply deficit, monetary conditions favoring hard assets, institutional capital beginning allocation. Each force independently supports higher prices. All 3 simultaneously create conditions for significant price appreciation. That's when ratios compress from 59 to 1 toward 32 to 1 or 14 to 1. That's when silver moves from $79 toward $135 or $309. Now, some will ask why Bank of America didn't make this forecast earlier if the conditions are so compelling. The answer is institutional conservatism. Major banks don't publish aggressive forecasts until data forces recognition. The data now is overwhelming. 5 consecutive years of supply deficits, gold breaking $4,400, silver surpassed its 1980 nominal high, Shanghai trading at sustained premiums to New York. These are signals that previous analytical frameworks no longer apply. When models break, forecasts get revised, sometimes dramatically. The timing also matters. Bank of America. This report was published in early January 2026. This coincides with when institutions make annual allocation decisions, when family offices rebalance portfolios, when strategic planning occurs. The report serves as a signal our analysis has changed. Consider adjusting positioning accordingly. And when Bank of America signals a shift, hundreds of billions in managed capital pay attention. Let me address the obvious question. If Bank of America projects silver between $135 and $309, why aren't they recommending everyone buy immediately? Because they're not in the business of retail advice. They provide institutional analysis for sophisticated clients. This report was written for hedge funds, family offices, sovereign wealth managers, the people who position before retail awareness. By the time mainstream financial media discusses this widely, by the time average investors hear about it from their advisors, much of the move will already be underway. Premiums will be elevated, delivery times extended. The window for optimal positioning is before widespread recognition, not after. And here's what distinguishes this cycle from 2011 or 1980. In those previous rallies, silver's price appreciation was driven primarily by investment demand, individuals buying coins, speculators trading futures. When that demand reversed, silver crashed. This time, industrial demand provides a foundation. Solar manufacturing doesn't sell silver when prices rise. Electric vehicle production doesn't stop. Data center construction continues. Industrial consumption is inelastic. It continues regardless of price. This creates a floor under the market. Investment demand still drives spikes, but industrial demand prevents complete collapse. This is why Bank of America can project $135 to $309 with institutional credibility. Because even if investment demand moderates, the structural supply deficit persists. Inventory drain continues. Industrial consumption grows. Price becomes the primary mechanism for market balance. When supply cannot increase quickly and demand cannot decrease, price must rise to ration available material. That's not speculation. That's supply and demand economics. Let me show you what this means practically. At $79, silver is already expensive by historical standards compared to the past decade. Most people look at the chart and think they missed the move, but Bank of America is stating $79 represents early innings, not late stages. If the conservative projection of $135 materializes, that's 71% appreciation from current levels. If the upper projection of $309 occurs, that's 291% appreciation. Most investors consider 20% annual returns excellent. Bank of America is projecting potential for multiples of that over 12 to 24 months. However, there's a critical consideration. The path from 79 to 135 or 309 will not be linear. Silver is volatile. It can move 5% daily. It can decline 15% in a week. The individuals who benefit from silver appreciation aren't those who check prices hourly. They're those who establish positions based on structural analysis, ignore short-term volatility, and maintain exposure until the ratio signals overvaluation. The ratio signals overvaluation when it compresses to 32 to 1 or lower. At current levels of 59 to 1, silver remains undervalued relative to gold historically. Bank of America's forecast also assumes current trends continue. No major currency collapse, no banking system failure, no geopolitical crisis beyond current levels. If any of those scenarios materialize, the forecast is likely conservative. In a genuine monetary crisis, silver doesn't stop at $135. It goes significantly higher, because when systemic confidence breaks, capital flows to tangible assets, and silver is the most accessible tangible monetary asset for most investors. This brings us to the final consideration: why this specific forecast matters more than others you may have heard. Because source credibility determines capital flows. When Bank of America makes a forecast, institutional money managers read it. They discuss it in allocation meetings. They adjust models. They rebalance portfolios. That activity creates self-reinforcing dynamics. As institutions allocate to silver, supply tightens. As supply tightens, prices rise. As prices rise, more institutions recognize the trend. The cycle reinforces. Bank of America's forecast isn't just analysis, it's a catalyst. By publishing this projection to their institutional client base, they're potentially initiating the capital flows that make the projection more likely. This is how markets work at the institutional level. Large players don't wait for confirmation. They position based on analysis and create the reality of their analysis projects. For those watching precious metals, this represents a significant development. One of the world's largest banks just told their wealthiest clients that silver could appreciate 71 to 291% from current levels based on historical ratio compression. They're not guaranteeing that outcome. They're stating the mathematical framework and structural conditions exist for it to occur. Whether that projection materializes depends on numerous factors, including gold's performance, ratio compression, supply deficits persistence, and institutional capital flows. But understanding what Bank of America sees provides insight into how sophisticated capital thinks about silver currently. They see a market in structural deficit. They see monetary conditions favoring hard assets. They see institutional allocation beginning. They see a ratio at 59 to 1 that historically compresses to 32 or 14 during precious metals bull markets. They run the math, and the math produces a range of $135 to $309. This isn't financial advice. This is an educational analysis of what one major financial institution is telling their institutional clients. What you do with that information is your decision. But recognize what it means when a bank of this size reverses their conservative stance on silver. It means their risk models suggest not having exposure is potentially more risky than having exposure. It means their supply chain analysis shows physical constraints that cannot resolve quickly. It means they see capital flows beginning that tend to be self-reinforcing. The timeline remains uncertain. Bank of America suggests 2026 into 2027. That's a window, not a specific date. Historical ratio compressions happen relatively quickly once they begin. In 2011, silver moved from $17 to $49 in approximately 7 months. That's 188% in half a year. If similar velocity occurs from $79, we reach $228 in 7 months. That exceeds Bank of America's conservative projection of $135 and approaches their upper projection. This is why the window for positioning is before widespread recognition, before CNBC runs daily segments on silver shortages, before your neighbor mentions buying coins, before premiums reach 30% over spot. That window exists now, when most investors still consider $79 expensive, when mainstream awareness remains limited, when physical metal remains available at reasonable premiums. Because here's the pattern institutional money recognizes. Smart money acts on analytical frameworks before consensus forms. They establish positions. Then they wait for markets to recognize what they already identified. Retail investors wait for confirmation. They want to see $100 first, then $120, then they buy at $140 after most appreciation occurred. Then they panic sell at $110 during normal volatility. Meanwhile, institutions positioned at $79, and they're selling to late entrants at $140. That's how wealth transfers occur. Early positioning based on analysis versus late positioning based on momentum. So where does this leave us? Bank of America just informed the investment world that silver could reach $135 to $309 based on historical ratio compression and current supply-demand fundamentals. They see 3 structural forces converging: supply deficits, monetary instability, and institutional allocation. They're positioning their institutional clients accordingly, and they're doing it now in early January 2026 when silver trades around $79. If the projection materializes, this will be recognized as a significant wealth transfer opportunity. If it doesn't, and silver consolidates or declines, Investors positioned will still own an asset in a structural supply deficit with limited downside compared to upside potential. The key insight is this. When institutions of Bank of America's size reverse their positioning, they're acting on data retail investors don't access. They're running models retail investors don't have. They're making billion-dollar decisions based on that analysis. You don't have to agree with their projection, but you should understand what they're communicating. And what they're communicating is clear. Silver at $79 isn't expensive relative to historical ratio analysis. It's a potentially early stage of a ratio compression that could drive prices to $135 or $309. The timeline is measured in quarters, not years. The path will include volatility. But the mathematical framework based on historical precedent suggests significant appreciation potential. Bank of America published this forecast. Their institutional clients received it. Now you know what they know. The only question is whether you understand the implications. Because when the smart money repositions based on structural analysis, patterns suggest following that analysis tends to be more profitable than ignoring it. Bank of America sees silver differently than they did. And when banks of this caliber change their view, markets eventually follow. The forecast is $135 to $309. The window to position before broader recognition is now. What you do with that information is entirely your decision.